You can't fear that stuff, guys. You can't. Look at the chart. The market's going to price in whatever purchasing power destruction is required to save that future recession, right? The market's way smarter than us. If the price is breaking out, it's above moving averages. It's mathematical. That means it's expanding away from your entry price. You're making money. And if ever before you get a 40% drop in silver, you'll see the daily chart fail. You'll see the weekly chart fail. You'll see a whole bunch of stuff fail. You'll have clues to step aside, right? But you got to listen to the charts. You have to, because I don't know how you could get that information just off Twitter or off X or off CNBC and be able to time all this stuff, right? To be nimble enough to exit before you get that 50% drop. Because if you wait, if you wait for that news event to tell you the coast is clear, you'll be in 2010, 11. It'll be too late,
Hey guys, my name is Danny and you're watching Capital Cosm. Today we've got North Star Bat Charts, Kevin Wadsworth, and what's your name again? Patrick Karim. Thanks for coming on, guys.
Yeah, good to see
Hey,
you again,
Danny.
Danny.
Yeah. Well, hey guys, before we get started, I'd like to remind you to hit that like and subscribe if you're getting value out of these videos. And with all that said, let's just dive right in, guys. What is your general view of the economy in the market specifically? Any charts you want to look at? What's top of the radar for you? What's what's at the helm of your headspace? Let's say. I'll start it off with whoever wants to take it.
Pat?
Go ahead, Kev. Go ahead. I'm just going to enjoy the show today.
Get your popcorn.
Do you want to answer that, Pat, or shall I? I mean, to be honest, Danny, it's a bit hard to know exactly where to start with what's going on at the moment. We've been talking just before we went on air there about all the problems that are going on in the Middle East there, and it's a mess. But as I commented just a second ago, the charts are really helpful at times like this when it comes to identifying geopolitical, financial, economic risk, and a whole range of charts that we've been showing over the last couple of years, at least, actually, have been pointing to the back end of 2024 and into 2025 as being a particular time of concern. When you're looking further ahead in the charts, it's always a little bit tricky to pin down the timing exactly in specific events and when they may occur. But I do think that what we're seeing going on in the real world out there is, as always, a reflection of what the technical charts have been suggesting. And without even having to pull up the charts, I can talk about gold breaking out and starting a huge bull run. I can talk about the extent to which stock markets are starting to look quite stretched, and the way that gold has been matching the performance of the stock market over a number of years now, actually, which a lot of people aren't aware of. And when you start putting these things together, particularly with the chart evidence, you start to build a picture of quite a sort of monumental period in time. I don't want to sound too dramatic, but these sorts of events really only happen maybe 3-4 times every 100 years or so. And I'm talking about capital rotation events that see capital shifting away from stock markets and towards precious metals, and how that ties in with other assets like silver and oil, commodities. I can dive into some of the charts if you'd like me to, and I can show you some of the things we're looking at.
Sure.
Let me just share my screen. Okay. So Pat might want to chime in at various points as well. But I mean, just starting with a very basic gold chart here, and you can see just how dramatic the breakout was. This is the back end of last year. And I put this little label on the chart, $600 to $800 move up, just as we were starting to break out here. And that's because a whole load of technical evidence suggested that would be the size of the move, sort of $600 to $800 from sort of 2000 to 2800, that kind of area. And we're progressing towards that sort of target zone at the moment. Whether it carries on much further beyond that before any sort of significant correction, we'll just have to wait and see. But certainly a huge move for gold, and that starts to get you thinking, doesn't it? And I just wanted to point something else out. Somebody was talking to me on social media this morning about oil, and I was suggesting that oil is likely to resolve to the upside. And they were saying, well, all sorts of fundamental narratives around the supply of oil, and that the US can ramp up its oil supply anytime it wants, and there's a glut of supply. Well, I would sort of argue against that really, and suggest that, well, the technical chart evidence over 100 years, certainly going back to the 1950s anyway, suggests that oil, silver, and gold are all basically the same, much the same chart. They're the same asset class. They react and respond to economic conditions in the same way. There's a little bit of a lag between them from time to time, but eventually they all start resolving in the same direction. Given that gold has just moved up $600, $700 and has broken out of a long consolidation, we can expect silver to do the same. We can expect oil to do the same. So the thesis going forwards over the next few years is that all three, gold, silver, and oil, are highly likely to move up by a considerable margin. And I'll put that green arrow on the chart. I mean, it's a lot smaller than the one back there in the 1970s, and it's also smaller than the one there in the 2000s. But even if we were to see that sort of a size move up, you can see oil there. I mean, that would be a bit crazy if we got close to sort of $300. Gold could very easily be $8,000 to $12,000, and silver could very easily be well north of let's say 130, 140, $150. So, and the time frame for that, you know, you're looking at several years, maybe 5, 6 years, something like that. But it does give you a big picture view of what the correlations are in all of these things. Silver itself is just one amazing chart. It's a huge 49-year cup and handle pattern. You can see the cup, you can see the handle, and if you zoom right in on that handle, you can see exactly where we are today. Price has broken out above $28, heading towards the target area for this particular cup pattern or arc pattern, north of $38 and quite possibly as high as 50 before we get a more significant pullback and then look towards the next move up. But more important than all of that, Danny, is the gold to SPX ratio and how we see these big rotation events that take place. You can see 3 of them on the chart here, one in the year 2000 where it bottomed out and we rotated away from stocks and towards gold. This is a ratio chart. When it's going up, gold is outperforming, and when it's coming down, gold is underperforming the SPX. So 3 rotations on this chart, one at the bottom there, another one at the top here where gold reached its bull market highs and then funds started flowing away from gold and towards stock markets again. And we're in the process, by all accounts now, in terms of technical evidence, of another rotation event. And we're seeing evidence of gold breaking out versus a whole range of assets. Gold has broken out versus the M2 money supply. It's broken out versus PPI and CPI. And it's close to breaking out versus the S&P. And it's gold breaking out versus the S&P and NASDAQ are probably the 2 sort of final parts of this jigsaw puzzle, because it's already broken out versus the Dow Jones, for example. The S&P, I did this chart for Twitter, called it the banana chart, but it's just me having a little bit of a joke. But what it basically means is that when you get this significant pullback in the SPX, these are capital rotation events. There's one here in the 1930s, another one in the 1970s, another one here in the period 2000 to 2012. You can see these capital rotation events, and they coincide with the S&P falling at least 50%. Each one of these is a 50% drop in the S&P. So a drop from where we are now, let's say 6,000 down to 3,000, it barely even looks like a blip on this chart, does it? You know, it doesn't look very significant, but it would be a 50% drop, and that would be your capital rotation event shown on the S&P chart. Gold has broken out versus the US dollar index. It's another very important signal of a precious metals bull market. You can see how we broke out in the early 2000s there, 2003, and you can see the previous bull market in the 1970s. And what this means is that gold is outperforming US dollar relative strength, because the US dollar index is an index of the dollar against primarily the euro. So what you're saying here is that gold is outperforming any US dollar relative strength, and that's a very strong sign for a gold and precious metals bull era. So that is yet another piece of the jigsaw puzzle. You can also look at the equal weighted S&P. This is another way of looking at it. This is the equal weighted S&P. If all of the stocks in the S&P were given equal weighting, and it's versus gold. So when the chart is moving down, it means gold is outperforming. And you can see very, very clearly on this chart that it's breaking down. If I zoom in for you, you can see that it is breaking down below the support line, horizontal support, breaking down below the Ichimoku cloud, which is this green and red splodge on the chart, this indicator, and it's also below the 36-month moving average, which is the green line on the chart here. So this chart is breaking down, which tells us that gold is outperforming and is in a bull market environment versus the equal weighted SPX, and that's a precursor to gold breaking.
Can you tell me from that peak in 2022 how much it's dropped percentage wise for the equal weighted? Because this is the point people don't admit. There's a bear market from the peaks. Yeah, there you go. It's dropped in percentage 25% already about. So in real terms, there's a stealth bear market happening right now for most of the US stocks, except, you know, the Magnificent Seven. There's a bear market happening right now of those peaks, right, that we had back in the 2022. So that is kind of not mind-boggling, but people have to consider that it's already happening in real terms. The capital rotation event. Of course, like, we're super defensive. We're waiting for that SPX. We want to see that 30-40% drop nominally denominated in fiat for those US indices to happen. You want that. That's what has previously happened in capital rotation events. But the setup, the weakness, the underlying weakness is evident by that chart that Kevin just showcased you. Sideways for about 6-7 years and down off the previous peaks, 25% already, the stocks, right? And it's starting to lose momentum more, right? Like Kevin said, below the 12-month, below the 36-month, below horizontal support, below, you know, it's that bearish evidence. It's there. And until that chart breaks to the upside through that dome there, that resistance, that dome, until it closes back above that 12-month or 36-month moving average, the bias is neutral, bearish, and more bearish as time moves on.
And you can see that even just by moving down that sort of 25%, moving down by 25%, we've gone from $1,200 gold when it touched the dome here to, well, I need to update these labels now, don't I? Because it's north of $2,600. So we've more than doubled. And when you look at the distance that this is likely to fall in the capital rotation event, you can imagine how many thousands of dollars gold is going to appreciate by when measured against the US dollar. And you can see the effect here. Previously, we went from $250 gold to $1,900 gold during the capital rotation event there. So gold doubled to 500, then it doubled again to 1,000, then it doubled again to nearly $2,000 there. So you can do the mathematics on that based on the starting price here. So another big piece of evidence that we're seeing a capital rotation event. And finally, I don't want to sort of go two more charts to show, actually, two more charts. This one here is gold breaking out versus CPI. And you can also do gold versus PPI, the producer prices. But yeah, a very clear breakout there. So gold has broken out versus consumer prices. And when that happens, as it did here in back in the early 2000s, it just confirms that we are in a bull market phase for gold. We were above the moving average here. We're above the breakout line. We were above the Ichimoku cloud. That puts you in a very strong bull market phase for gold. So fast forward to today, above the moving average, above the Ichimoku cloud, above the breakout lines. I've marked two of them on here. So we're now in clear air, effectively. Gold versus CPI is in clear air. And just finally, the chart that a lot of people seem to like, I put this chart together a little while back. It's my sort of chart that I use to summarize the risk of a major market and geopolitical event. I've stolen this risk matrix from my time in aviation meteorology and working with emergency responders. We would give warnings for severe weather, things like storms and flooding and that kind of thing. And it's an assessment of the likelihood of an event and how severe the impact is going to be when the event comes along. So I've assessed that based on historical evidence, when this yield curve in chart uninverts, when it crosses back above the zero line, the risk of or the event is going to be a high impact event. This is the 10-year yield minus the 2-year yield, and it's usually a positive number, but there are times when that's forced into a negative situation. But it's what happens when it becomes positive again, and when normal conditions reassert themselves. And I've said to you before, I'm not an economist. I'm just here observing what happens. And each time there's a named event that comes along. Also, perhaps more importantly, recessions. If I were to put the recession indicator on this chart, you can see the recessions very clearly. And the recessions come along just after this chart comes back above the zero line. This is a quarterly chart, so it could be 3 quarters until it happens, which is obviously 9 months, but it can be much quicker than that. It can happen within a couple of months. So we are looking at a very, very likely recession. And because of the depth of the inversion and the length of time it's inverted, then it may be that recession is a particularly nasty one. We'll have to wait and see. But we have a high likelihood of a high impact event now. These things aren't just, charts. We're not just talking about stuff that's going to happen in the charts, gold going up or silver going up or oil going up. We're also talking about real world events, which is what led me about a year or so ago to put this label on chart saying that plausible deniability and distraction are coming. The point I'm making there is that this chart has been created by mankind. It's not something that just happens. The chart has been created by the actions of the Fed and its interest rate policy. And all the decisions around debt dynamics and what the central banks are doing and what the Fed does is what creates this chart. It's been made by the idiots in control. Sorry about being so dismissive of our great leaders and so on, but if I can see this chart, I'm sure they can as well. I'm sure they know what they're doing. I'm sure they know the dangers of what they're doing, the risks of what they're doing, and I've absolutely no idea how we get ourselves into these positions time and time again. You think we would learn, but no, apparently not. So we have yet another nasty period to live through, I'm afraid. And you switch your TV on, see what's happening, and I'm afraid it's all a reflection of that.
Kevin, don't close that. Just overlay the unemployment rate. Yeah, there you go. Indicators. Do you have unemployment? Yeah, you're writing too much. You're writing too much. It's not an indicator, Kevin. It's a compare. It's a symbol.
Oh, okay. So of course, yeah. Okay.
Sorry, I might have said indicator. So check it out, guys, and you'll see that it's all the macros, all the fundamentals, the stories, and whatever's spooking the Fed. Look at the unemployment rate. He's going to overlay it. Look how it matches that. Look at that. look at that. Do you see that? That's what's the beauty of doing charts like we do. We see charts and charts and charts and patterns and patterns and patterns.
So it's the red line right there.
Yes, the red line.
You can hide the ticker on the top left, but without us having to understand what the cause is, and if there is a cause or there are multiple causes, but we get to see the correlation. And I know that when I see a chart, I've seen that chart before. And then I know, it looks like the unemployment chart. It looks like the ASA chart. It looks like the gold and silver miners chart. And right away, my brain starts picking out all these images, right? It's like, you've seen an image. It's easier to mix and match in your brain images and you see what's happening here. And look, the unemployment rate, every single time that it's turned up that much off the bottom, it's never just stopped there. It's at least doubled. So if you think the unemployment rate is about to double, then it looks like this yield curve on inversion is going to continue upwards, that this new trend in yield curve on inversion is not just a blip, it's going to go back up. And then, of course, recessions. But I put also something on Twitter there. I asked ChatGPT, because I couldn't find the data, for all of these recessions, tell me when they were officially announced, because that green overlay Kevin's showing you, that's the official. I'll show you that, man. This is bonkers, Danny. Before you,
I think I saw it on your Twitter last night.
Yeah, I asked, I think it was a viewer that showed me that. And then I said, oh, ask ChatGPT because I couldn't find the data, guys. Look at all these recessions. The actual start date was 2007. That's what Kevin showed you, the green overlay, right? Yield curve, uninversion, unemployment rate going up. But look, 1 year later, they officially announced it. Goodness,
Mhm.
you're so behind. It's like almost, and it ended in June. Like you're almost out of it. And if you're waiting for them to announce the end of the recession, or in 2010,
Another year later. Yeah.
it was a
Yeah,
full, like
same
the
thing. You know, when
recovery was on. Like it's like,
people feel like it's a recession and it hasn't been announced, they're damn right it's a recession because it is. By the time it's announced, as
yes,
Pat said, it could be almost over.
and you can't. The market's gonna front run that, and this is their serial, and it makes sense because they're officially announcing them based on data. But how much time does it take for the data to trickle down for them? Look at that, the 2001, 8 months later to announce it, 2 years later before they close the shop on it. If you're waiting for that to realize you're out of it, the market's smarter than you guys. It's already started to price in the recovery, right? In the 1991, I had more examples, but it wouldn't fit in one print screen. They're all like that. Never, I'm not sure they were ever at the same time that it happened. Maybe, yeah, I don't know. I haven't seen it. So look at that. So
I,
you got to
I'm
know
looking
that.
at the actual start date versus the actual the start date announced versus the actual end date. I mean, and they're like, take 2001 for example. When they announced that the recession started, it had pretty much ended already.
Yes.
Well, thanks for telling us, guys.
Yes. Yes. For that one, yes. Yeah. It's crazy. They're that slow. If it's a shorter recession, it could be over by the time they announce it. Like, it's
1990 91, they announced it after it was over.
yes, 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 over. Crazy, right? For how many a year later? What? What?
They announced it a month after it was over.
Yes. Officially ended, right?
Yeah.
That's crazy. So, yes. So that's why, guys, look at charts. Look at charts. Look at the data because that's what matters. Because if you wait for the official stuff, the oh, we're in a recession. Goodness, it's guaranteed. So right now we could already be in a recession. I don't know. Well, let's see how they backfill it there. I don't know what their criteria are, but I don't care. That recession indicator, it's fun for us because it makes people relate to the charts. Oh, it's a recession. But at the end of the day, yield curve uninversion, unemployment rate going up, the gold and silver miners going up. That's not good for the mom and pop. And then there's these, and look at the steel price. It's like it's been going down for a while. I get feedback from people that work in the steel industry. It's even oil that's been going down right now for the past since the peak. That's signs that that's recessionary stuff, right? It's disinflation. It's even the inflation going down could be signaling that we're in a recession right now. And oil could break out before they even announce the start of the recession. But people looking at charts could say, okay, maybe the worst is behind us. If I see oil breaking out and silver not crashing and all the stuff going up, we could already be out of it, right? Unless something bigger happens later on, right? So you got to look at the charts. If you could only make money if you buy and the price goes up and away from your entry price, you could live in the fear of a recession and never get into the silver train. Look, I want to show you this chart, guys. Am I still sharing my screen?
Yep.
Look at this. This is a 2008. I don't know if it's going to happen exactly like that, but that's what I show people. This is silver, the daily chart, in 2008, the official start of the recession, right? Silver goes
Yep.
up, up, up. And then after that, it plunges in the abyss of it. And then after that, it recovers way before.
So
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 if you
hold on,
wait,
hold on. So the green shaded area is the recession.
that's right.
Okay.
Look at silver melting up in the recession, in it. It's
Mm-hmm.
going up. And then after that, it bottoms. And then after that, it goes back up. That happens a lot of the times where it's like a V shape in the recession. People think it's like a recession, but it goes down, it flatlines and goes up. No, market falls into it, the abyss of it. And then there's a recovery way before it ends, right? It doesn't always happen like that. A lot of the times you'll see that. So if you're waiting for them to backfill it officially, you're gonna miss out, right? You're gonna let's say people right now, this is what's happening with silver. People are scared of the recession. Yes, we could be in one, there could be a bigger one happening. So they're not playing the breakout now in silver. They're not playing the breakout wherever because I'm scared there's gonna be a rug pull. There's gonna be a rug pull. Well, the rug pull could be from much higher up. Silver ran up 40% here, 44%. What if silver goes up to whatever, 48.50, and then you have the recession, and then you have a pullback, a 50% pullback or 30% pullback, but you're from 50, right? You're going to go down to
Right.
what, to 30, 35. You're going to miss all that run, right?
Also, don't forget, Pat, that there were two recessions in the 1970s, and silver went from $4 to $50 in the 1970s, more than a 10x with two recessions whilst it was happening.
You can't fear that stuff, guys. You can't. Look at the chart. The market's going to price in whatever purchasing power destruction is required to save that future recession, right? The market's way smarter than us. If the price is breaking out, it's above moving averages. It's mathematical. That means it's expanding away from your entry price. You're making money. And if ever before you get a 40% drop in silver, you'll see the daily chart fail. You'll see the weekly chart fail. You'll see a whole bunch of stuff fail. You'll have clues to step aside, right? But you got to listen to the charts. You have to, because I don't know how you could get that information just off Twitter or off X or off CNBC and be able to time all this stuff, right? To be nimble enough to exit before you get that 50% drop. Because if you wait, if you wait for that news event to tell you the coast is clear, you'll be in 2010, 11. It'll be too late,
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top-notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys. Yeah. So going back to this capital rotation event, it seems like gold moves first, but and you've talked about this with the popcorn thing, commodities. When does the larger commodity complex work to the upside? Gold. It appears that gold leads, but then you're supposed to start seeing some of these other resources and commodities start to move after. How much longer? Because we've seen gold move pretty violently to the upside. The question would be, how much runway do we still have left, at least in this localized run? And question two, when should we expect to see some of these other commodities and like energy resources move in tandem as well?
Yeah, so the idea of commodities catching up and playing catch up is a little bit of a misleading thought process, really. I wouldn't think of it in those terms. I would think of it in terms of individual technical chart analysis and just waiting for the confirmed breakouts in each one of those commodities. So, for example, yes, gold has moved from 2,000 to 2,650 as I speak. Silver has not reached its all-time high yet. So people say, well, silver's got to play catch up. Well, on what time frame? How long is it going to take? What's the target? How far away from the moving average? You can't just say that silver's got catch up to play. It doesn't work that way. You have to look at the gold to silver ratio, see where the target is on the gold to silver ratio. There are a number of steps you need to take before you can have some realistic targets. Silver at the moment, and silver has broken out above clear resistance at the $28 level. 28 is now a support area. It was a resistance level. So silver now has its chance to make whatever move it wants to make towards that 50 target. If you want to identify the top end target for this particular move, then $50 really is it. I mean, there are techniques that give you much higher targets over a longer time frame, but this particular move from the $28 breakout has a target no higher than around about $50. It may fall short of that. It may end up 40, 45. I don't know, but this is silver's opportunity now, right now, this next few weeks, to make a run towards 50. How close it gets to 50, we won't know until it's pulling back and in a major pullback. So we need to just keep a close eye on the daily chart, daily support levels, watch for a breakdown, watch for that breakdown rolling over onto the weekly chart, because that's when the run is over. It's when it's reached its rough approximate target area. And because silver is such a volatile metal, I mean, it could have an intraday wick that goes to 50, and then by the end of the day it closes at 45 or something crazy like that. I mean, towards the end of its run, it could move, dollars a day quite easily. By the time you get to $50, after all, $5 is only 10%. So so you can quite easily imagine, moves of several percent and several dollars towards the end of the run. So my point here is that oil, silver, whether you're looking at steel, iron ore, coal, all of these commodities, you have to look at them individually on their technical charts, make that assessment as to where the breakout levels are, and not try and the idea of sort of sitting down thinking, well, what's the order that they're going to break out in? Which ones are going to go first? Which ones are going to go next? I mean, after all, uranium broke out a long time ago. That's a commodity. Uranium is a metal, and it broke out in 2020. So we're talking 4 years ago now. Huge bull run for uranium and uranium miners. Then a lot of consolidation, another move up, another consolidation appears to be just ending now. So, if we talk about what went first, you could argue that uranium really, went a long time ago, and so did gold. In fact, gold had a big move, same sort of time. So, don't get caught in this, mindset of, it's got to play catch up or attach whatever kind of fundamental, theory you want to. But having those sort of fundamental storylines, people like them, but seriously, pull a chart up, draw a single line on the chart. Sometimes that's all you need. One line shows you where the resistance level is. Cross that line, great, turn bullish. That's the case with Bitcoin at the moment, Danny. Bitcoin has broken down versus gold. I don't know why people can't see this, but Bitcoin and crypto total market cap are breaking down versus gold. They're below the moving averages, the 50-week moving average. They're below the Ichimoku cloud on the weekly chart. They're below support lines. So cryptocurrencies and Bitcoin are in a bear market environment versus gold at the moment, as defined by technical chart analysis. And as soon as that changes, as soon as they break out and they move through a breakout line, then we can say, yeah, we favor Bitcoin over gold, and Bitcoin is outperforming gold. But since March of this year, Bitcoin has not been outperforming gold. Gold has been outperforming Bitcoin. So just use TA, use the facts. Don't get, so many people on Twitter are sort of, oh, Bitcoin this and Bitcoin that. But okay, great. I quite like Bitcoin for what it stands for, but why lose money in the process? I don't get it. Bitcoin reached its target. Its target was 69, 70,000. That was the measured move target. Step aside. Wait for it to play out from that point onwards. It clearly hit resistance. It was clearly stretched. Step aside, and that's what we suggested. Step aside. Wait for it to play out. It was a cup pattern, so we thought a handle may form on that cup. Maybe it would. Maybe it wouldn't. Turns out it has. There is a handle pattern on that Bitcoin chart. Will it play out as a handle, or is it going to break down? Well, there are some signs that it's breaking down. As I said, it's certainly breaking down versus gold, but we're quite prepared to flip into a bullish mindset. But the critical thing is when the technical chart evidence tells you can do that, not when some bloke on Twitter writes something that has something to do with the power law or whatever. Maybe that's great for a 50-year time frame, but over the last few months you would have lost 30-40% versus gold. So the answer, go into gold. Gold's broken out, outperforming Bitcoin. Make money in gold, rotate it into Bitcoin when that situation changes.
And also, kind of piggybacking off of the recession charts, what is a recession at this point? I mean, classically, we defined it as 2 consecutive quarters of lack of GDP growth. But when we were looking at those various recessions, what is their definition based off of? Just so we make sure we're comparing apples to apples moving forward.
Yeah, probably gonna have to ask the National Bureau of Statistics there. But it wasn't it 2 negative quarters of GDP? That's the
that was a
I wonder
classical
if that
definition.
changed.
But then they said, oh no, well, it's not really that. So what
Yeah.
are we using to measure what a recession is?
Well, yeah, we're probably gonna have to review that and ask. But again, as chart traders, that's exactly the point. Who cares, right? You could change the definition of something. You can't change the price chart. You could change whatever you think it is. Oh, it wasn't a recession, it wasn't. Well, silver went down 40%. The yield curve on inversion kept going up. The unemployment kept going up. You could call it or not a recession. Like even in the, I don't care, because the symptoms, the aggregate of all these macro elements playing together, creating these charts. And I know that, let's say, my gold and silver miners track that unemployment uninverting, going up. And I just know that I'm in a highly correlated environment where I have a weight of evidence that the plays I do in whatever sector are going to have a better chance of reaching their targets.
What people fixate on the word recession, what does it matter what you call it, especially when the data's backfilled and you don't know about it until months or even more than a year later? It doesn't matter what we're calling this thing a recession, but what if, and this is just a what if something similar to the 1970s comes along? And there were two recessions in the 1970s that took place over fairly short time spans in that 10-year period between 1970 and 1980, when gold went up by hundreds and hundreds of percent, right? But what if, like the 1970s, those two recessions are set in an environment that is stagflationary? What if we've got a stagnant economy, and what if we've got stubborn or rising inflation? The reason I say that is because the chart I showed you earlier on showed gold, silver, and oil all moving steadily to the upside. Now, that might be counterintuitive in a recessionary environment, but what about stagflation? What about, I mean, gold absolutely loves that kind of situation where you've got a stagnant economy and inflationary pressures. And to tie in with all of that is the 10-year yield, Danny. The 10-year yield, lest we forget, recently broke out of a 40-year downtrend. And when you break out of a 40-year chart-defined downtrend, it's giving you a signal. It's telling you something. What's it telling us? Well, it's telling us that that downtrend is over. It's finished. Forget it. It's history. So we're into some kind of new phase for the 10-year yield. Now, I know the 10-year yield got to 5% and it's pulled back to whatever it is, 3 point something, but it does not change the fact that we have broken out from that 40-year downtrend. That could very well mean that we've got a now 40-year period where we have stubborn inflation, or maybe it's 20 years, who knows, but we are in a different environment. So don't necessarily expect that what's happened over the last 40 years, from 1980 to now, to apply, because there are a lot of charts telling us that it does not apply. So do not compare, anything that's happening now to anything that's happened in the last 40 years. You're better comparing it to maybe the 1940s and 30s or the 1970s.
Gotcha. And Kevin, you did mention while we were getting ready for this interview that you did post an oil chart on X recently. Anything you guys want to talk about specifically about oil? It seems to be acting kind of erratic given some of the conflicts going on around the world.
Well, yeah.
Pat might pull a chart up, but whilst he's doing that, I'll tell you the conflicts around the world have far less to do with it than you might think. The headline-driven, this is where I said distraction and deflection and all the rest of it. Plausible deniability was the phrase I used, I think. The charts have been telling us for quite a while, with Brent crude and with US oil and whichever oil charts, that we've seen a breakout and we are now having what looks like a bullish pullback on the long-term timeframes. So yes, if you zoom out and you look at long-term at what's been happening with oil, all of this put in context is occurring above a breakout level. So I think unless oil falls below somewhere around the $60 area, might be $60 to $63, somewhere around there. Unless it falls below that and gets a quarterly close below that, then Pat's drawn the chart pattern on for you. See breakout there, and that's a bullish wedge forming on top of a breakout. And the most likely resolution for this, particularly when you consider that gold is broken out, is for this to resolve to the upside. It might be, in the next, it might be in the next 2 or 3 months. It might be next year, it might be, something terrible happens in the Middle East and they start bombing the hell out of the oil refineries and nuclear power stations, and suddenly everything goes off the top of the chart. That could be it. But the point is here that, they will try and tell you that that event is what caused it. But if that's true, how is it that we're able to now, and 6 months ago, tell you that that was what was highly likely to happen? How is it that the chart was telling us that was going to happen? These are technical chart patterns that play out over a long period of time, setting up these bullish and bearish chart patterns. And if we break out above that $80 area, then suddenly we've got a target that takes us all the way beyond. I can't read the numbers on there, Pat, but
200.
There you go, 200.
I got about 200 there. It's
people say
$200
$200 oil. We can't have that. What's the gas? What's it going to be costing at the pumps? At the gas stations, and how can the world survive on $200 oil? Well, just look back at what happened last time. Oil has moved up by that percentage, many times in the past. And the world didn't end.
Yes. How do you come up with $200 oil though? What's the rationale?
The measured move here.
It's a measured
pull,
move.
flag, pull. And also you could have a whole bunch of other type of, here's my distance from moving average at the bottom pane. That's my distance from my 36 quarter moving average. So I know that it's not the price, guys. It's not what the price is nominally. It's how stretched are you from the mean. If you're in an uptrend, but you're not stretching so far from the mean where you have a statistical probability that you have to, you have to correct, like the moving average catch up. I know here that oil is able to go 72% up. That'd probably be my intermediate target. So I'll just show you what it looks like here. Here's my 36 quarter moving average. So if I go up 72%, that's probably my halfway flag. I'm just going to show you what that moving average looks over time, right? Because if the price keeps going up, that's going to go at the very least at this angle, maybe faster. And this is my distance for my moving average, 72% above until I stall. So I'm probably going to go up $125 is going to be the next leg up if ever it breaks out. And after that, my 130% above, that's my longer term target, 130 like that. But later on, I don't know where my moving average is going to be, but you see, I'm able to stretch. So I've shown historically in these melt up tops for oil, the 2008 one, I'm able to stretch that much and then peak, hit a target. I'm not saying it's going to stay at 200, right? It could peak there and then we go in a bear market and it corrects 150% and we go back down to 50 or whatever. People think, oh, 200 is going to stay there forever. Often that's not the bulk of the move right here. Look here, my high volume node. Oil has been stayed at 70. It's kind of its mean, right? It's $70. It's been at 120. It's been down at 30. It's been down at 0. But the bulk of it for the past 20 years, 18 years, oil has been at $70, right? And before that, the mean or like the average, look at that, it was at $18 from 1979 all the way to 2003 for 25 years. It oscillated around $20-25, right? So if this thing unleashes up there, the price is going to try to find a new sideways range where it's going to stay, right? So maybe we're going to, for the next 20 years, we're going to hover around 120, 125 for the next 20 years after this, going up and down, up and down. So the distance for moving average will tell you how much fuel you have left. You guys remember the oil chart, essentially it's like the compounded effects of inflation on the US dollar. It oscillates with inflation rate, or the inflation rate represents the oil price, the oil components, but it also compounds on the purchasing power destruction, right? The continual inflation, just how it compounds, and it has to reflect that in its own chart, right? It represents the inflation rate, but also because the inflation rate destroys part of your purchasing power, the price of itself, oil, it stacks up, right? Like, it's not the price of 200 oil that should scare people. It's relationship to gold. If gold is up, doubled, and oil doubles, for me, nothing changes. It's just the fiat that's been destroyed, right? It's the illusion, because if all asset classes go up nominally, price in fiat, nothing's changed, right? a barrel of oil still, you could convert it for X amount of ounces, you could convert oil. It's nothing has changed, right? There's supply and demand dynamics where these ratio charts in between non-fiat denominated will oscillate. But it's only when you price it in something that's getting depreciated logarithmically that you see those instruments go up. So don't be scared, guys, of $200 oil. And for me, it's just what's its relationship to fiat, but what's its relationship price in oil and silver and gold. That's what you have to worry about, right?
Well, hey guys, thank you so much for coming on. For people who want to get more of your information and insights, be sure to check out the website down below for North Star Bath charts. We have the link in the description box as well as the pinned comment. So be sure to check that out if you're interested. Also, like and subscribe if you got value out of this content, and check out our Substack for the full interview, capitalcosm.substack.com. Fellas, anything else you want to say before we wrap up?
Let's do it again soon, Danny.
All righty. Until next time, guys. Catch the next episode. Bye, y'all.
Remember General Electrics or General Motors, the chart? Now I think it went back up, but for decades that thing kept trending. Stuff doesn't have to keep going up all the time. Maybe the SPX.
People do forget, don't they, that the SPX fell 50% twice in 2001 and then again in 2008. There were two 50% drops within a few years of each other.
Yes. In the 70s, it did what, 30, 40%, like three times?
It had three drops in the 70s, and it was sort of 25%, 35%, and 50, something like that. 25, 35, and nearly 50%. I think the overall drop was about 50%, so it was a death by 1,000 cuts in the 1970s. And so for people now to sort of think a 50% drop in the S&P, 80% drop in the NASDAQ is unthinkable, well, think about it, as I would say to that. Just seriously think about it and look at the evidence for capital rotation. Price it in gold, price the S&P in gold, because that will save you from, total wipeout.